want to take a bit of a different look at the stock market. I want to do that with Don Wordell. He's fund manager for RidgeWorth Capital Management. His RidgeWorth Mid-Cap Value Equity Fund is in the top 3% of its class over the 5-year period. Good to have you here on Street Smart, Don. The macro cross currents that we seem to be getting daily, how do you make sense of them? How do you make investment decisions? Is it pretty tough?
Well, it's just really difficult to try and figure out all the cross currents that we're seeing with, all the different issues with sovereign debt in Europe and Moody's and S&P with their threats to the U.S. Sovereign rating. And, what we do is we just pick stocks from the bottom up. We start down at the bottom fundamental level and look into companies and try to eliminate as much noise as we can. Although we don't manage money in a vacuum or a black box, so to speak, it's difficult in this environment right now.
Well, let me talk a little bit about the performance of your fund, because you've got a great long-term track record. We mentioned being in the top 3% of your class, but this year you are lagging so far. What's going on?
Well, what's going on this year so far has been the financials. The financials have been a weight pulling us down a little bit this year. And when you break down the financials, or you peel the onion back on our financials weighting, it's really our overweight in banks. We see over the next 2 years tremendous value in banks. Our process revolves around dividends, valuation, and fundamentals. These companies are all their balance sheets have been repaired, capital has been repaired. But there are some top line issues. Where's loan growth going to come from? And then all the regulatory issues, the foreclosure litigation. I mean, I understand why the banks have been lagging, but at the end of the day, I think the stock price is at 8 times forward earnings and close to tangible book value for most of them. There's some attractive investment opportunities here over the next couple of years as they recover.
And I hear you, Don, but we've been talking a lot today about the Moody's story, about how B of A, Citigroup, and Wells Fargo might be downgraded by Moody's. What they're worried about is that the government will limit its support of the largest financial firms. So there's some concern in terms of too big to fail. I know you don't really buy into the large cap names, but how might some of that impact the mid cap names, or not at all?
Well, that's why we like the mid-cap names, because I feel like stocks like B of A, Goldman Sachs, they have big bullseyes on their backs. I mean, I really think that, if whatever you think your earnings are going to be in 2 years, you should probably put an 8 multiple on that, and that's your stock price. The mid-caps don't have that type of target on their back, and they also have the pretty well diversified business models. You take a look at a BB&T or a Comerica. These stocks are pretty compelling from a valuation perspective, and what we're really waiting for there in those stocks is not so much regulatory as it is loan growth. And we think that as the mortgage portfolios begin to stabilize and get better, they are growing their C&I portfolios, so we will see loan growth over the next couple of years.
But Don, let me just ask you. Take a look at something like Comerica. It's down about 18% this year. I mean, that's got to hurt. You don't want to back off that position at all?
No, in fact, I've been buying more. I mean, Comerica's trading at real close to tangible book value. We see $5 in earnings power in 2 years. They've got 40% of their deposits are demand deposits, which is essentially free capital. And they're positioned really well in Texas. They're growing in California. And look, the other half of their business has been in Michigan. Michigan's been in a recession for a decade. So they've been dealing with it. Their credit is in great shape, and their capital is in great shape. They've got $1 billion in excess capital they're going to put to work. So, I look at Comerica and think that stock can trade back into the low 50s over the next 2 years. And from $34 today, that's a pretty attractive return with what I think is limited downside with the stock trading at tangible book value.
Is there some point, though, where the stock goes down too much and you say, I've got to back out, this isn't good for my fund, and certainly not for the performance?
Well, of course. I mean, there are stocks that we look at that if we're just wrong on the fundamentals, look, if in 2 or 3 quarters we look out and we're not, and C&I loan growth and loan growth isn't materializing, and then maybe the regulatory environment is worse than what we're estimating right now, if I'm wrong on the fundamentals, I have absolutely no problem selling stocks. And that's happened. I mean, there have been plenty of stocks that we've sold over time that we've been wrong on the fundamentals. But right now, we just feel like we're in a good spot with Comerica from a risk-return perspective for the next 18 to 24 months.
So we're talking financials. I also want to talk a little bit about the consumer group retail. Sheila, I want to bring you into this because you've been looking at the retail sales figures that came out today.
Yeah, Carol, and they were really a mixed bag, disappointing for the most part. In fact, about 60% of the companies that came came out with earnings today actually missed expectations. So some of the big losers really were in that middle end. So Gap, for example, JCPenney, Kohl's, Target, all companies, examples of companies who missed expectations, and where you actually saw strength or in both ends of the retail spectrum. So on the one hand, on the very, very high end, like a Saks or a Neiman Marcus, posting some very strong results. If you can believe this, Saks actually posted a 20% gain for the month of May when it comes to comp store sales. So that stock obviously up. Neiman Marcus also did well. And then also on the much, much lower end, you had Target, Costco and BJ's Wholesale Club also doing very well. Though those stocks are down, one of the big reasons is that gas was one of the big boosts for their sales. You know, actually Costco said that 50% of their May comp store sales was because of rising gas. You know, my question to you, Don, is I know you don't necessarily look at the macro picture all that much when you're picking out individual stocks, but just considering that the pressure that consumers are under with rising gas prices, with inflation, with, you know, just trying to go paycheck to paycheck, and the unemployment picture still the way it is, what's your take on the consumer and how is it affecting some of your picks going forward?
Well, so consumer discretionary is one of the areas in the market that we're underweight for all the reasons that you just described. One thing that I don't think you mentioned was just the amount of debt out there that the consumer is dealing with. And then when I look at consumer discretionary stocks like the ones you've mentioned, like Gap, and one that we've sold recently because we were wrong on the fundamentals, which was Staples, there's just so much excess capacity in retail. We built so many stores that, you know, I just don't see where square footage growth, where growth in earnings is going to come from. And so we remain underweight, and I think that these stocks are all going to get re-rated lower. And we feel like 4 to 6 times EBITDA is the range they should trade in. Most of them are still, even Gap now is trading at, I think, 5.5, 6 times EBITDA after pulling numbers down with their last report. So we're still not really attracted to the stock at these levels.
So, Don, definitely you're seeing some risk there when it comes to that retail space. Adam, I want to bring you into this because speaking about risk overall, those money market traders, they don't seem too concerned right now.
No, they're not concerned, at least not if you look at the TED spread. And that is very simply Treasuries, T-bills, 3-month T-bills versus LIBOR. And there it is. Look at it. You can see the angst back in 2008 shot all the way up to 500 basis points. Right now, it's at about 21.5 basis points, has barely budged. Don, my question to you, who's got it right? The money market traders who are not pricing in any risk, if you look at that chart, versus the stock traders who've taken 2.5% out of the S&P in just 2 days. Who's got it right?
Well, at this point, you know, it all depends on your time frame would be my answer. You know, if you're looking out over the next 12 to 24 months, I would say that the stocks are the place you want to be investing right now. Over the next 3 months, I can't answer that. But over the next 12 to 24 months, I look at most of the stocks, all the stocks that we own, and I see strong fundamentals in that good balance sheets, strong dividend yields, strong fundamentals, and very compelling valuation. You know, in the consumer space, one stock that we own is American Eagle at 4 times EBITDA relative to 6 for the group. So, you know, we still see a lot of value there. You know, corporate balance sheets are in great shape and earnings are in pretty good shape. So I would say longer term stocks are where you want to be.
Don, we got to run. Thank you so much. Don Wordell joining us this afternoon.